our community of business academics is kind of obsessed with this question of, firm size. Do big firms do better at times like this? Do small firms do better at times like this? Do we see concentration growing as the industry dominated by a few big firms? Or do we see dispersion, lots of little firms happening at times of real change like this? Our next presenter is Sagit Gill, a postdoc here with us, and she's had the opportunity to study this question of the distribution of firm sizes in a very, very novel environment. So, Sagit?
Thank you. Looking for the clicker, not finding it. Okay, great. So thank you very much. This is a joint project with Eric and with Nir Haq from Harvard University. So researchers have been interested in the distribution of firm sizes for many years now. They've been looking at firm sizes at the industry level, at the country level. Ours is the first time that we've done an analysis of firm sizes at an online marketplace, and we do this using eBay data straight from their servers thanks to our great collaboration with eBay. And this great data set also allows us to look at the evolution of the firm size distribution over time. Now, firm size distribution is a lens for studying market structure. It tells us something about concentration patterns, and it also allows us to answer the question of to what extent do we see larger firms dominating the market. Researchers have been looking at firm size distributions using number of employees, sales, assets, all as proxies for firm sizes. They've been coming up with one general conclusion, that is firm sizes are highly skewed. So we see the larger firms are much larger than the smaller firms in the market, so they're pulling the average away from the median, away from the mode, and creating this tail of big firms. But what is exactly the shape of this tail? Now here we see two answers coming up in the literature. So the literature basically diverges. Some researchers say, oh, it's a log normal distribution, and the others say, nope, it's a power law. And what's the difference? Well, the log normal actually implies a lower degree of market concentration with fewer larger firms. And we see evidence of both of these distributions coming up in data for US firms, UK firms, but generally firms in Europe, and Japanese firms. So the literature really diverges. So a good way to think of what we expect the firm size distribution to look like is to theorize about the generating mechanism. Well, log normals are the result of multiplicative processes. And for firm sizes, the first and highly stylized but very well accepted model was proposed by Gibrat in 1931. And what he says is that if we assume that firms have already reached their minimum efficient scale, so now operating under constant returns to scale, we can theorize that now their growth would be size independent, and basically we can describe growth as a series of idiosyncratic shocks. Now all you need to do is take logs, apply the central limit theorem, and then you get a log normal distribution of firm sizes. Now, to get a power law, turns out you just need to add some noise into this process. So if we think of very realistic things going on, like firms entering and exiting the market and having a lower bound for firm size, then we get a power law, just applying Gibrat-style growth and adding some noise. This is very intuitive because if we think of a log normal distribution, if we think of some firms exiting at different sizes and some smaller firms coming in, then all of a sudden the older, larger firms who stay in the market are now relatively larger, and this is what makes for a power law type of tail. Graphs are coming in a minute. But still, empirically, we find both log normal distributions and power laws. So a good way to reconcile this is to understand that the power law is the steady state or long run solution that we would get. And this can take tens of years in the market until we arrive at this power law shape. And indeed, this is what we think is going on eBay. Now, a word here I have to note, eBay lawyers are very averse to forward-looking statements. So let me very cautiously say, in the period of our analysis, we find eBay's firm size distribution is better fitted by a log normal than by a power law. So concentration isn't very extreme, but we do see larger sellers growing larger in the way that is very consistent with convergence towards the power law. And before I get into the details of our analysis and our interesting results, let me just take a brief minute and a side note to tell you that power laws and log normals are absolutely everywhere. So researchers across the sciences have been fascinated by these highly skewed phenomena that we see in both the natural world and in man-made phenomena. And the frequency of words in Moby Dick has been one of the first power laws identified, and actually one of the best fits that researchers have found. So we can also think of our study of this firm size distribution question as part of this broader agenda of understanding what shapes dominate, can explain our world. Okay, so we're analyzing the evolution of eBay's firm size distribution. We have data for a 10-year period, 2005 to 2014. We're also going to examine the size-growth relationship, looking for evidence for Gibrat-style size-independent growth. I'm not allowed to quote statistics on entry and exit of firms on eBay, but as you can imagine, this is an online marketplace, so turbulence is quite significant. Our result, as I mentioned, eBay's firm size distribution is better fitted by a log normal throughout our period of analysis, but we do see larger sellers gaining a larger share of sales over time, which is in line with convergence towards the power law. And we see Gibrat-style growth being the case for top-selling firms. So it is a good description of what's going on in the right tail of the distribution. Okay, we are going to look at annual sales for sellers with sales of at least $10,000 a year. These are defined by eBay as commercial sellers. So eBay firms are much smaller than traditional firms. So bear that in mind as we go through the analysis. We're going to use both cross-sections of firms, so this is analyzing all the firms active in the market in a certain year, but we're also going to follow cohorts of sellers. So these are firms that start in the same year, and then we're following them over time in the market. Now we've talked about what's the lower threshold, what's the lower bound for firm size, how big is the top, how large are the largest firms. Well, they are definitely not big box. eBay's largest sellers are over 5,000 times smaller than Walmart. And now we can start looking at all the graphs. Okay, so to analyze the firm size distribution, we draw this graph, this plot that is the complementary cumulative distribution function, or CCDF. So the way to read this is this work. Yay. So for a certain level of sales, a point tells us the probability that a firm that we draw in random has sales at or above this level. Looking at the black dots is the empirical CCDF. This is the actual fraction of firms in our sample with sales at or above a certain level. The blue line is the power law fit, the green line is the log normal fit. And we are in log-log scales, so the power law looks as a straight line and the log normal curves down. And this is actually our way of seeing that the mass in the power law regime is larger. So the power law would predict more larger firms and more mass in the top tail of the distribution. Now, how much more? Well, I actually did this quick computation this morning. So if we think of firms with annual sales over $100,000, then if we believe the blue line, it tells us that they command 40% more share of total sales than the green line. So this is a substantial difference. And as you can see that the green line fits the data much better and remains to be the better fit throughout our period of analysis. So the log normal is the better fit. Now, how is it evolving over time? It's quite striking to see that the log normal tail is growing slowly over our period of analysis. And this is basically coming from the growth of the largest firms in the market. So on the right panel, we see top versus bottom quartile of sellers. And we can see the top slowly rising in share of sales as the bottom slowly declines. We can do this quartile versus quartile plot drilling down into the top of the distribution. So within the slice of the top 10%, top 1%, top 0.1, and top 0.01, we plot bottom versus top quartile, and until 0.1%, we see the top rising and the bottom dropping, and here it starts getting a little messy. So what this picture tells us is that the increase in concentration is coming from the very top. And this drill down is also another way to show us that we're not dealing with a power law yet, because if it were a power law, then the pattern would be fractal, and these graphs would be surprisingly the same, and they're not as yet. We do the same analysis at the product market level, so looking at different categories, and it's quite striking to see that these regularities hold out pretty well. So clothing, shoes, and accessories, collectibles, computers, tablets, and networking, sporting goods, home and garden, business and industrial. Our results hold for most categories. Actually, in the few categories where it doesn't hold so well, it simply, these categories are ones where we can't statistically distinguish between the fit of the log normal and the power law, rather than having the reverse outcome. All right. We also asked the question of what's the role of firms aging and what's the role of selection in the patterns that we identify. So when we look at a cross-section, we have firms operating for 15 years on eBay alongside those who have just entered. When we think of the question of selection, then we have firms entering, we have firms exiting. Even if we follow firms who started in the same year, right, some have dropped out of the market. So are survivors any different? In the interest of time, I'm not going to get into the second question, but let me just tell you that we find that selection has a limited role in our sample. But age is quite neat to look at. Here we follow the cohort of firms that start in 2005. So these surviving firms, we follow them for 10 years. And you see that once we have cleaned away the effects of entry and exit, the log normal fit is now really striking. And when we plot the log normal fit for this group over time, now it's really clear to see how the bottom has lost mass and this has been gained at the top of the distribution. So we really see the shift as the distribution kind of turns on a hinge. And the next thing that we look at, as I promised, we're going to look at the relationship between size and growth rate and look for evidence for Gibrat-style growth. And these are our estimation results. We find that indeed in the top of the distribution, these coefficients are not statistically significant, so this tells us that we do have size-independent growth for top sellers. When we pool all sellers together, we find a negative correlation between size and growth, so small firms are growing faster than larger firms. And this has been found previously in the literature. It's not really surprising because we think of this as smaller firms having accelerated growth until they reach their minimum efficient scale. In the middle, it's actually interesting to see that if we look at the top 50%, top 25, 10%, we see a positive relationship, meaning that the larger firms grow faster than mid-sized firms. And more on that in a minute. Let me also tell you that we find younger firms grow faster on eBay, and this is coming out across the distribution. So summarizing our findings on growth patterns, as I said, we find Gibrat-style growth for top sellers. Smaller, younger firms are the fastest growing firms on eBay, so this has been found in other markets and is not very surprising. We can even think of, when I go to search for something on eBay, I look for a product, I don't look for a seller. So it is basically, this finding is telling us that eBay is healthy in that sense. It's not blocking, it's not giving advantages in search results to larger sellers compared to smaller sellers, and basically the result is what it would be in other markets. larger sellers growing faster than mid-sized sellers, we can think of some advantages due to scale still operating here. But another angle for thinking of the slower growth for mid-sized sellers, this can also reflect eBay's role as part of the gig economy. So we can think of sellers that have grown to some comfortable size for them and that have decided to keep the same volume of their operations on eBay. These are not really large firms. So they may be driving an Uber, they may be selling somewhere else online, or just pursuing other vocations. So to conclude, we find that in terms of the firm size distribution, eBay replicates the general regularities that we find in different markets, but with lower barriers to entry and smaller winners. Thank you.
Questions?
Yes.
It's a question about what eBay will do with this type of information. You know, for example, one of your conclusions was medium-sized companies tend to be caught somewhere in the middle, and presumably that means maybe they fall off or disappear or whatever.
Yes.
You know, and so does eBay look at this and say, okay, I can interfere now with this by giving some incentives to medium-sized companies? Or
So what I can tell you is that eBay is very interested in making sure that there are good opportunities for growth across the distribution of firms. And I can actually tell you that Eric and I are working on another project with eBay as they're now rolling out this dashboard for having data-driven decisions at the small business level. So they are very interested in this, and basically by offering this sort of dashboard supporting data-driven decision-making, even for small businesses. We assume that large firms have this in-house, but they are really trying to provide tools for their sellers and support them. And I know some of their moves in the past have been, at least in the media, described as more favoring larger sellers, but I think they're making a very conscious shift towards trying to help sellers in the full range of the distribution and caring about what's going on with the smaller sellers, indeed.
excellent, thank you.
Okay.